Hi, Todd Rosenbluth here at Inside ETF's Inside Smart Beta conference here in New York. What's exciting about this conference is we're going to talk with many of these industry experts about their new products, what makes them unique, and key drivers in the industry. I'm here with my friend Eric Balchunas of Bloomberg Intelligence. You know, a lot of the things that you and I both write about are focused on demystifying things in the ETF market. And I think there's a lot of fear that ETFs are actually driving stock performance as opposed to stocks driving ETF performance.
Yeah, this is the tail wags the dog theory, and most of the myths out there and the occasional attacks on ETFs can really be sort of wiped out with one chart. And since I don't have a chart here, I'll just describe it. If you took a bar chart of the size of the stock market, it's gone from 10 trillion to 29 trillion over the last 10 years. Why? Because people want stocks.
Right.
They're using ETFs to buy them to an extent. If you put US equity ETF assets and you put that on the same chart, you'd barely see the little white bar next to this huge blue bar because ETFs only own about 8% of the stock market. So as you talk about all the time with GE, and there was a stock recently, Sears.
Yeah.
Stocks go down all the time, even though they're in ETFs taking in a lot of money. So this idea that stocks are not moving with fundamentals is not correct. And then if you throw index funds onto that 8%, you get to about 16% held passively. That's still really not enough to call the shots. If you think, I like to tell people this, active calls the shots. They lead the market. If active likes Facebook or Amazon, that big chunk of 60% is going to buy it, and it's going to get a bigger increase in the market cap weighted indexes. So there will be some more buy orders because of that, but certainly that's just following active's lead. And if active sells something, it's going to slowly become a lower weight in the indexes. So you have to consider active sort of the front, and if anything, the ETF and index fund is the tail following sort of the tip of the spear, which would be active.
Yeah, and not only that, but to go further, not all index funds are created equal, and the exposure that you're going to get from, we're here at a Smart Beta conference, the exposure you're going to get in a low volatility ETF and the exposure you're going to get in a momentum oriented ETF are night and day from one another. It really gets down to what's inside it, and we're seeing just a whole bunch of things that are changing with new products that are coming out.
Yeah, look, someone had said, I forget who it was, that index making is the new active. And so I'd say it's a version of active, basically taking your secret sauce, what you think is a good way to weight fundamentals and screen for them, and then just making an index out of it. And that's part of the reason you've seen an uptick in indexes. More people are designing their own indexes. And essentially, it's just an active strategy. It's almost like you're building a droid, right, to do exactly what you want it to do. That's why I sometimes refer to active as smart beta as an artificial intelligence version of an active manager. It's like your own personal R2-D2, but it has a lot more. It has traits like a human being. It's not completely passive. It's really, if anything, more active, and that would also and this whole thing of all this passive money buying up stocks. I agree with you because value ETFs literally buy the stocks that aren't favored as much by market cap, and there's tons of money going in those. So are those also distorting fundamentals? You don't really hear that much. The argument is usually a basic kind of sour grape complaint by somebody who might just be struggling in their business.
Right, and so if you're an active manager that's seeing outflows, as many of them are, you're going to feel pressure. You're going to look for someone to point to in that space. The same thing if you're charging money, I think, is moving out of expensive mutual funds and going into low-cost index-based strategies. That's a good thing for all investors.
Yeah, listen, nobody making CDs was hot about the MP3. It was not good for the music business. This is tough on the whole industry. But I have found that scapegoating ETFs and passive is certainly not effective. If anything, the more scapegoating, the faster the assets go or the flows go into passive. What I would do if I was active, and some managers do this, is they say, okay, we're in this new world, let me figure out a way around it. And they actually like it. They're like, I think I have better ways to make money off of this. Here's my plan. I'd much more sign up for that person than somebody saying, oh, this is ruining the market.
Right, and a lot of good choices that are out there. The industry continues to get larger. That's a good thing in that investors have more choice. That's also a bad thing in that investors don't always know what to do with it. But there's filtering tools you guys have, Bloomberg have, we at CFRA have, to be able to narrow down that universe and be able to understand the risk and reward opportunities, or specifically the risk. That's a part of what you're focusing on, of how risky a strategy may be and red flags that are out there.
Yeah, sure. So, due diligence, we have a little 5-step process: exposure, cost, liquidity, risk, like standard deviation, and structure. If you just go through those 5 things, and then you look at a few fields within each one, you're good. And then on the whole idea of dangers, obviously standard deviation and looking at the holdings will alert you, but we have a system we call the traffic light that's kind of cool, where we look at potential nasty surprises in an ETF, sort of like going through the prospectus and some historical data to say, is there anything in this ETF that would surprise you in a bad way? We're not saying whether it's going to go up or down. That's Todd's job. We're basically just saying, like the movie rating agency, is this ETF rated G, PG, PG-13, R, or NC-17? How much could you get hurt? And that is sort of a rating system we're trying to provide, because let's face it, people just don't read the prospectus. People will say, if like around XIV, when that was a big problem, they're like, oh, well, it was in the prospectus. I'm like, all right, yes, XIV, I get mixed feelings on XIV, but it certainly wasn't something people were reading on page 65 of the prospectus. So I do think there's need for a system and middlemen like us, I guess, to sort of make it easy on the investor to pick an ETF, know of dangers coming along, but ultimately it's not that hard to do due diligence. Look at the holdings, look at what it costs. What is its performance versus the index been like? It's not rocket science, although we should make it out to be, so we can stay employed
make more
longer.
Money. Yeah.
We
can stay employed more.
Yeah.
Well, Eric, thanks a lot for joining us. Good to be with you.
Thank you, Todd.
Thanks a lot.